The global monetary order rests on one foundation. Oil is priced in dollars. Every barrel traded, every tanker loaded, every futures contract settled requires American currency. This isn't a market preference. It's an architecture built deliberately over 50 years, and it's the only reason the United States can print trillions without immediate collapse. But that foundation is cracking. When oil no longer needs dollars, when the pricing mechanism fractures, when alternative settlement systems mature, a chain reaction begins. Not sudden collapse, structural disintegration. The dominance unravels step by step, predictably, and what comes after reshapes everything about how power operates globally. Let me show you the domino sequence, how each piece of American financial architecture depends on the piece before it, how the petrodollar sits at the base, supporting dollar demand, treasury market depth, banking system liquidity, and global monetary dominance, and how once that base weakens, once oil transactions migrate away from dollars, even partially, the entire structure adjusts downward, not overnight, over decades, but irreversibly. This has happened before. The Spanish Empire ran the global reserve currency for 150 years, backed by silver from Potosi. When alternative trade routes developed and silver flows diversified, Spanish dominance eroded across generations. The British pound sterling served as the world's primary currency for a century, backed by industrial exports and naval power. When both declined after 2 world wars, the pound's role diminished gradually, painfully, across 40 years. The pattern is consistent. Reserve currency status isn't binary. It doesn't switch off. It fades as the underlying support structures weaken, and each stage of that fade triggers adjustments throughout the system. The petrodollar sits at the center of modern American power, and understanding what happens when it weakens requires understanding what it actually does. Not the myths, not the oversimplifications, but the specific mechanisms that create dollar demand and enable the current system. Start with the basic structure established between 1973 and 1975. After the Nixon shock ended dollar-gold convertibility in 1971, American policymakers faced an existential problem. Without gold backing, why would anyone hold dollars? The answer was constructed through negotiations with Saudi Arabia and other Gulf producers. Oil, the most essential commodity in industrial civilization, would be priced exclusively in dollars. OPEC members would accept only dollars for their exports, and critically, Saudi Arabia would recycle its dollar surpluses into US Treasury bonds. The mechanics matter. Every country needs energy. To buy energy, they need dollars. To get dollars, they must export to America or to other countries that export to America. This creates structural dollar demand independent of American economic fundamentals. Germany sells cars to earn dollars, to buy oil. Japan exports electronics to accumulate dollars for energy imports. China manufactures goods to build dollar reserves for commodity purchases. The whole system revolves around acquiring dollars not to trade with America, but to buy oil from the Middle East. This demand supports everything else. It allows the Federal Reserve to expand the money supply without immediate inflation because new dollars are absorbed by global energy markets. It ensures deep liquidity in treasury markets. Use oil exporters recycle hundreds of billions into US bonds. It makes dollar-denominated debt attractive globally because dollars are needed constantly for energy transactions. The petrodollar doesn't just support the currency, it supports the entire dollar-based financial architecture. Now watch what happens when this foundation weakens. Not disappears, weakens. The dominoes don't fall instantly, they shift position, they adjust, and each adjustment triggers the next. The first domino is pricing alternatives. This is already happening. In 2023, Saudi Arabia began accepting yuan for some oil sales to China. Russia sells energy to India in rupees and rubles. The UAE has opened yuan clearing houses. These aren't total departures from dollars, they're options, diversification. But each alternative transaction reduces dollar demand by that exact amount. Here's the mechanism. China imports 10 million barrels of oil per day. If even 20% of those purchases shift to yuan settlement, that's 2 million barrels per day no longer requiring dollar acquisition. At current prices, that's roughly $50 billion per year in reduced Chinese demand for dollars. That's 50 billion fewer dollars China needs to earn through exports, hold in reserves, or recycle into treasury bonds. Multiply this across multiple buyers and multiple producers. If 10% of global oil trade migrates to alternative currencies over a decade, that's 200 billion per year in reduced structural dollar demand. That doesn't sound catastrophic, but it's not isolated. That reduced demand doesn't vanish, it shows up elsewhere in the system. The second domino is reserve accumulation. Central banks hold dollars primarily for two reasons: to intervene in currency markets and to pay for energy imports. If energy can be purchased in other currencies, the necessary level of dollar reserves decreases. Not to zero. America still runs the largest economy and deepest financial markets, but the required allocation drops. Watch how this plays out. A country that previously held 60% of reserves in dollars might shift to 50%. Not because of political hostility, because of practical need. If they can settle 25% of energy imports in yuan and 10% in euros, they need fewer dollar reserves. That 10 percentage point shift in global reserve allocation represents trillions in reduced demand for dollar-denominated assets. Where does that money go? Into other reserve assets. UN bonds, euro bonds, gold, IMF special drawing rights. This isn't dollars collapsing, it's dollars losing market share in the global reserve portfolio. And that market share loss triggers the next domino. The third domino is treasury market depth. The US Treasury market is the deepest, most liquid bond market on Earth. Daily trading volume exceeds 600 billion. This liquidity exists because global actors need dollar assets, and treasury bonds are the safest, most liquid option. Foreign governments hold over 7 trillion in US Treasuries. That demand allows the US government to borrow at lower rates than economic fundamentals would otherwise permit. But if foreign reserve managers need fewer dollars, they buy fewer treasuries. Not suddenly, gradually. Instead of buying 100 billion in new issuance per year, they buy 80 billion, then 60 billion. Eventually, they become net sellers as old bonds mature and aren't fully replaced. This reduced demand doesn't cause immediate crisis. Markets adjust, but the adjustment is higher interest rates. If foreign buyers absorb less US debt, domestic buyers must absorb more. That requires higher yields to attract capital away from other investments. The Federal Reserve can intervene, buying bonds to suppress rates. But that means expanding the money supply further, which feeds into the next domino. The fourth domino is monetary expansion limits. Right now, the Federal Reserve can expand its balance sheet dramatically without triggering immediate inflation because excess dollars are absorbed globally. When oil producers receive dollars, they invest them in treasuries or dollar assets rather than spending them in American markets. This offshore dollar circulation acts as a release valve. But if oil transactions increasingly happen in other currencies, fewer dollars circulate offshore. More remain in domestic markets. The same level of monetary expansion produces more domestic inflation because the dollars aren't absorbed externally. This forces the Federal Reserve into an impossible choice: either accept higher inflation or tighten monetary policy despite government borrowing needs. Either choice weakens the structure. Higher inflation erodes confidence in dollar value. Tighter policy increases government borrowing costs and risks recession. There's no option that maintains the current system's stability once external dollar absorption decreases significantly. The fifth domino is banking system liquidity. The global banking system operates on dollar liquidity. International transactions clear through dollar correspondent banks. Trade finance is predominantly dollar denominated. Emerging market companies borrow in dollars. This creates constant demand for dollar funding in global banking markets. When petrodollar flows weaken, dollar liquidity in the international banking system becomes scarcer. Banks that previously received dollar deposits from oil exporters now receive fewer. This tightens lending capacity and increases the cost of dollar funding globally. We've seen this dynamic in past dollar funding crises. In 2008, foreign banks faced dollar shortages despite dollars being available because the recycling mechanism broke temporarily. If petrodollar recycling diminishes structurally, rather than temporarily, dollar funding becomes permanently tighter in international markets. This doesn't destroy the system, but it reduces American banks' competitive advantage and decreases the dollar's utility for international transactions. Banks and companies begin preferring other currencies for trade finance because dollar funding becomes more expensive and less reliable. The sixth domino is sanctions effectiveness. American financial power rests heavily on the dollar's centrality to global transactions. Sanctions work because cutting off dollar access means cutting off energy purchases, trade settlement, and international banking. Iran, Venezuela, Russia, All face severe economic pressure from dollar-based sanctions because they can't easily access energy markets or international trade without dollars. But if energy and trade can be conducted in alternative currencies, sanctions lose force. A country cut off from dollar systems can still buy oil in yuan, settle trade in rupees, and access non-dollar banking channels. This doesn't eliminate American leverage, but it reduces it significantly. The strategic implications are profound. If sanctions become less effective, American ability to shape global behavior through economic pressure diminishes. This forces reliance on other tools, military, diplomatic, which are more costly and less flexible. The dollar's role as a policy weapon weakens exactly as its role as an energy currency weakens. They're connected. The seventh domino is fiscal sustainability. The United States runs persistent government deficits, currently around $2 trillion per year. This is sustainable only because Treasury borrowing costs remain relatively low despite enormous debt levels. Foreign demand for Treasuries keeps yields suppressed. That demand exists partly because of dollar reserve needs driven by petrodollar recycling. If foreign Treasury demand decreases as reserve needs decline, borrowing costs rise. A 2 percentage point increase in average Treasury yields adds roughly $700 billion per year to federal interest costs within a decade as old debt rolls over at higher rates. That's $700 billion annually that must come from higher taxes, reduced spending, or more borrowing. More borrowing at higher rates accelerates the spiral. Interest costs consume a larger share of the budget, forcing more borrowing, which pushes rates higher, increasing costs further. This is the debt trap mechanism applied to the hegemon itself, and it's triggered by reduced foreign demand, which flows directly from weakened petrodollar dynamics. The eighth domino is inflation pressure. As dollar demand decreases internationally, more dollars remain in domestic circulation. Simultaneously, import costs rise because a weaker dollar makes foreign goods more expensive, and government spending continues or increases, requiring monetary expansion to finance deficits as borrowing costs rise. These forces converge to create structural inflation, not hyperinflation, not overnight currency collapse, but persistent inflation in the 5 to 8% range that's difficult to suppress without severe recession. This inflation erodes living standards, weakens consumer demand, and creates political instability. Critically, this inflation is structural rather than cyclical. It's not caused by temporary supply shocks that resolve. It's caused by reduced international dollar demand meeting continued domestic dollar creation. The only solutions are either dramatically reducing government spending and monetary expansion, which causes severe recession, or accepting persistent inflation, which gradually erodes dollar value and global confidence. Neither option maintains American financial dominance. Both represent adjustment to diminished dollar centrality. The system is compressing to a smaller role, and that compression is painful. The ninth domino is capital flow reversal. Currently, capital flows into dollar assets despite relatively low yields because of safety, liquidity, and necessity. Investors accept lower returns on treasuries because they need dollar assets for various purposes, including energy transaction reserves. As those needs decrease, return requirements rise. Capital becomes more discriminating. Instead of accepting 3% yields on treasuries because of utility value, investors demand 5% to compensate for currency risk and opportunity cost. This higher required return represents capital flowing away from dollar assets toward alternatives offering better risk-adjusted returns. This capital flow reversal amplifies every previous domino. It pushes treasury yields higher, tightens dollar liquidity, increases inflation, and forces more aggressive monetary policy responses. It's not a cause, it's an accelerant, and it's inevitable once dollar utility decreases below a critical threshold. The 10th domino is geopolitical realignment. Financial architecture shapes geopolitical alignment. Countries within the dollar system orient their foreign policy partly around maintaining dollar access. Countries outside face pressure to realign or accept isolation. This creates a gravitational pull toward American geopolitical positions. As alternative financial architectures develop, built around non-dollar energy trade, that gravitational pull weakens. Countries can pursue independent foreign policies without risking financial isolation. Middle Eastern producers can balance between American and Chinese interests. European nations can chart more independent courses. Emerging markets can diversify partnerships without fearing dollar cutoff. This doesn't create anti-American blocs necessarily. But it creates a multipolar financial environment where American preferences are one input among several rather than the dominant consideration. The world doesn't reject American leadership, it simply becomes less dependent on it. And that reduced dependence translates directly into reduced American influence over global outcomes. Now let me show you the timeline, not predictions with specific dates, but the structural sequence that unfolds once the base starts weakening. In the early phase, which we're in now, the changes are barely visible in aggregate data. Oil trades in alternative currencies represent single-digit percentages. Reserve diversification appears gradual and modest. Treasury markets remain liquid. Interest rates stay manageable. Most analysts dismiss the shifts as minor adjustments. The system appears stable. But beneath the surface, the architecture is reorganizing. Infrastructure is being built. The Chinese cross-border interbank payment system expands. UN clearinghouses open in commodity exporting nations. Bilateral currency swap agreements multiply. These aren't yet replacing dollar dominance. They're creating alternatives that can scale when needed. In the middle phase, perhaps a decade in, the aggregate numbers start shifting noticeably. Dollar share of global reserves drops from 60% to 50%. Alternative currency oil trades reach 15 to 20% of the total. Treasury auctions show weaker foreign demand. Interest rates trend upward despite Federal Reserve intervention. Inflation persists above historical norms. The American response during this phase determines how rapidly the deterioration accelerates. Attempts to enforce dollar exclusivity through sanctions or pressure backfire, pushing more transactions toward alternatives. Fiscal discipline could slow the process, but political systems resist austerity. Monetary tightening to defend the currency causes recession, which creates pressure for expansion. Every policy option involves painful trade-offs, and the political system likely chooses short-term relief over long-term stability. In the later phase, perhaps 2 to 3 decades out, the dollar retains importance, but no longer dominates. It becomes the largest currency in a multipolar system, rather than the overwhelming hegemon. Other currencies handle significant shares of global trade, reserves, and energy transactions. American borrowing costs normalize to match economic fundamentals. Government spending adjusts downward as debt service consumes larger budget shares. This isn't collapse, it's adjustment to a smaller, more constrained role. America remains a major power with a significant economy and deep financial markets. But the unique privileges of petrodollar-backed monetary dominance fade. The ability to run persistent deficits without immediate consequences diminishes. The capacity to project financial power globally contracts. The system functions, but on different terms with different limits. History shows this pattern clearly. Britain's pound lost reserve dominance gradually across 40 years, from 1914 to 1954. Sterling remained important throughout. London stayed a major financial centre, but the special privileges of monetary dominance eroded as underlying structural supports weakened. Trade shares declined, military reach contracted, and financial leverage diminished. The process was neither sudden nor complete. Even today, the pound is a reserve currency and London is a global financial hub. But the scope and scale of British monetary influence contracted permanently from its imperial peak. The system adjusted to Britain's reduced structural position, and that adjustment reshaped British power comprehensively. The dollar is following a similar trajectory, starting from a higher peak with more underlying strength, which means the process unfolds more slowly. But the mechanism is identical. Structural supports weaken, monetary dominance gradually contracts, and power adjusts accordingly. Now consider what this means for the institutions and families positioned within this architecture. They're not passive victims of these shifts. They're adapting, repositioning, and in many cases profiting from the transition. Major financial institutions have already diversified beyond dollar-denominated assets. They hold significant positions in yuan bonds, European debt, emerging market securities, and commodities. When the dollar weakens, these alternative holdings appreciate relatively. The same institutions that profited from dollar dominance are positioning to profit from multipolar currency markets. Energy producers are diversifying their reserve holdings and establishing new financial relationships. Saudi Arabia's sovereign wealth fund invests heavily in Asian markets. The UAE positions itself as a yuan offshore hub. Qatar builds strategic partnerships across both Western and Eastern financial systems. These actors aren't choosing sides. They're ensuring they profit regardless of which currency system dominates their future transactions. The wealthy families and institutional investors who understand monetary history are adjusting their portfolios accordingly. Increased gold holdings, real assets, geographically diversified investments, and reduced exposure to long-term dollar-denominated debt. They're not betting on dollar collapse. They're hedging against dollar contraction, which is both manageable. Meanwhile, the general population in America and other dollar-dependent economies remains largely unaware of these structural shifts. They see inflation, rising costs, stagnant wages, and increasing economic pressure, but don't connect these symptoms to the underlying monetary architecture changes. The pain of adjustment falls disproportionately on those who can't diversify globally, who hold primarily dollar-denominated assets. This is the consistent pattern across monetary transitions. The informed and mobile adapt early and prosper. The general population adapts late and suffers, not because of conspiracy, but because information and options flow unevenly through social structures. Let me show you the specific channels through which you personally experience the petrodollar weakening, even if you never think about currency markets or energy pricing. First, inflation becomes structural rather than transitory. Your wages might increase, but purchasing power erodes faster. This isn't temporary supply chain disruption. It's the permanent repricing of goods as dollar buying power diminishes internationally. A weaker dollar makes imports more expensive, and in a globalized economy, that affects nearly everything you purchase. Second, interest rates remain elevated despite economic weakness. Normally, recessions bring lower rates as central banks stimulate, but if foreign treasury demand is weak, the Federal Reserve can't lower rates without risking currency crisis. You face higher mortgage costs, higher car loan rates, higher credit card interest, even during economic downturns. The normal policy responses don't work because they're constrained by dollar's weakened international position. Third, government services contract while taxes increase. As debt service consumes larger budget shares, less remains for other spending. Either services are cut or taxes rise to maintain them. Likely both. You get less infrastructure investment, reduced social spending, weakened public services, while paying more to finance existing debt obligations. This squeeze is the direct fiscal consequence of losing the reserve currency discount. Fourth, economic volatility increases. Currency fluctuations create uncertainty for businesses, making investment and hiring decisions harder. International trade becomes riskier and more expensive. Supply chains that depend on stable dollar pricing face disruption. This volatility translates into job insecurity, business failures, and economic instability that affects your employment and income prospects. Fifth, geopolitical instability rises. As financial leverage weakens, America becomes more likely to use military force to protect interests that could previously be defended through economic pressure alone. You experience this as increased military deployments, higher defense spending, and greater risk of conflict. The transition from financial to military tools of power is dangerous and expensive. These aren't future possibilities, they're present realities accelerating as petrodollar architecture weakens. You're already living through the early stages of this transition. The question isn't whether you'll experience the effects, it's whether you'll recognize what's causing them and understand the trajectory. Now let me show you what this isn't. This isn't a prediction of dollar collapse next year or American decline into irrelevance. Those narratives are both wrong and unhelpful. The dollar will remain important for decades. America will remain a major power. But the scope of monetary dominance and the privileges it provides are contracting predictably as structural supports erode. This also isn't a political story about particular leaders or parties destroying American power through bad policy. The structural dynamics transcend individual leadership. Any administration faces the same constraints. Once the petrodollar foundation weakens, policy choices affect the speed and pain of adjustment, but not the fundamental trajectory. This is a story about architecture, about systems built on specific foundations that begin adjusting when those foundations shift. The petrodollar provided unique structural support for dollar dominance. As that support weakens, every system built on top of it adjusts downward accordingly. Understanding this lets you see past the noise of daily economic news and political rhetoric to the underlying structural reality. Inflation isn't caused by excessive government spending alone. It's amplified by reduced international dollar demand. Interest rates aren't high because the Federal Reserve is hawkish. They're elevated because foreign treasury buying is weaker. Geopolitical tensions aren't random. They're intensified by the transition from financial to military power tools. The domino sequence is mechanical, predictable, and already in motion. Recognizing it doesn't give you perfect foresight, but it gives you pattern recognition. When you see news about oil priced in yuan, or treasury auctions with weak foreign demand or persistent inflation despite recession, you'll understand these aren't isolated events, they're connected pieces of the same structural transition. And that understanding changes how you interpret everything happening in the global economy and American power structure over the coming decades. The architects of the petrodollar system in the 1970s built brilliantly for their time. They created a foundation that supported 50 years of monetary dominance. But they built on geopolitical conditions that are shifting. American military dominance in the Middle East is less absolute. Alternative economic powers have matured. Technology enables non-dollar settlement systems. The foundation they built isn't collapsing, but it's weakening under changed conditions. The institutions and families that benefited from that architecture are already repositioning for what comes next. They understand that power isn't permanent, that systems evolve, and that profit comes from adapting to structural change rather than denying it. The question for you is whether you'll recognize the transition while it's underway, or only in retrospect when the adjustment is complete and the opportunities to adapt have passed. This isn't about predicting specific crisis dates or picking particular investments. It's about understanding the direction of systemic change and the mechanisms through which that change affects everything from grocery prices to geopolitical stability. The petrodollar system is weakening. The dominoes are shifting position, and each shift triggers adjustments throughout the architecture of American financial power. This process unfolds over decades, not weeks, but it's underway now. It's predictable in structure, if not exact timing, and it reshapes the global order you're living in. If this changed how you see inflation, interest rates, and geopolitical tensions, if you understand now that these aren't separate problems but connected symptoms of the same structural transition, then you're seeing the architecture rather than just the surface events. Subscribe if you want to keep tracking these patterns as they develop, because the mainstream narrative will keep treating each domino as an isolated surprise rather than the predictable sequence it actually is. They'll give you the symptoms without the structure, and understanding the structure is the only way to see what's coming before it arrives. The system isn't breaking suddenly, it's adjusting to changed foundations. And that adjustment is the defining economic and geopolitical story of the next 30 years. You're living through it right now. The question is whether you see it.